If you've ever looked at a chart and thought, why does price always hit my stop and then go exactly where I predicted? Stay with me, because this video might save you a lot of money. If you trade crypto, forex or stocks, and you're tired of feeling like the market is playing against you, hit subscribe right now. This channel is about understanding how price really moves, not chasing hype. Now disclaimer, and listen carefully. This content is for informational purposes only and does not constitute financial or legal advice. Alright, let's get into it. Most people believe price moves because of news, indicators, or patterns. That's the story you hear everywhere. But the real driver of price is something much simpler and much more uncomfortable to accept. Liquidity. The market doesn't move to reward good analysis. It moves to where the money is. Every time you place a stop loss, a take profit, or a pending order, you are literally telling the market where your money is sitting. And when millions of traders do the same thing in the same obvious places, those areas become targets. This is where most people get it wrong. They think institutions predict price. They don't. They engineer movement by accessing liquidity. Think about it. Big players cannot just buy or sell whenever they want. They need the opposite side of the trade. And who provides that? Retail traders, especially emotional ones. That's why price often moves against the crowd before going in the right direction. It's not manipulation, it's mechanics. Let's talk about stops for a second. Where does the average trader put a stop loss? Below the last low, above the last high. Nice, clean, logical levels. Those levels look smart, but they're also completely predictable. And predictable equals exploitable. So when price suddenly spikes below a support level, triggers stops, causes panic, and then instantly reverses. That's not random. That's liquidity being collected. This is why breakout traders lose money consistently. They buy the breakout, right where smart money is selling into them. And then they say, fake breakout. No, it wasn't fake. You just entered where liquidity was needed. Here's the uncomfortable truth. Most indicators are just emotional comfort tools. They don't show you where money is forced to act. They show you what already happened. Liquidity shows you where pain will happen next. Once you understand that, charts stop being mysterious. You start seeing price as a hunt, not a pattern. Highs and lows aren't just structure. They're clusters of orders. Consolidation isn't boring, it's accumulation. Violent moves don't come from nowhere. They come after liquidity has been built up long enough. If this already sounds different from anything you've heard before, leave a comment saying liquidity. I want to know you're actually following this, not just listening. Now let's clarify something important. This doesn't mean you should trade every stop hunt. It doesn't mean you fade every breakout. It means you stop asking, is this pattern valid? And you start asking, who is trapped here? When you shift that mindset, your entire approach changes. You stop chasing candles. You stop entering late. You stop feeling surprised by moves that make no sense. Because they do make sense, just not from a retail perspective. And here's where most people fail. They want certainty. But markets don't reward certainty. They reward patience and positioning. Smart money waits. Retail rushes. Smart money lets price move first. Retail reacts emotionally. And that difference alone explains why 90% of traders lose. For now, let this sink in. The market doesn't care about your setup. It cares about where orders are forced to execute. And once you see that, you can never unsee it. Now let's get practical. Because understanding liquidity conceptually is one thing, but knowing how to spot it on a chart is what separates traders who survive from traders who donate. Let's start with the most important rule. Liquidity lives where traders feel safe. That usually means previous highs, previous lows, equal highs, equal lows, trendline touches, and obvious support or resistance. Any place where you think, yeah, this is a logical stop loss, so does everyone else. And that's exactly the problem. When price approaches a high that has already rejected multiple times, what do most traders do? They short. They put stops just above that high. Now think like a large player for a second. If you want to sell a large position, you need buyers. Where are buyers forced to buy? Above that high, when stops get triggered. So price pushes up, breaks the high, triggers stops, creates panic buying. And that's where selling actually happens. That's why price often reverses after breaking key levels, not before. This is also why equal highs and equal lows are so important. They are not just patterns, they are liquidity pools. The cleaner they look, the more dangerous they are. Another big mistake traders make is entering too early. They see price approaching a level and jump in because it makes sense. But smart money waits for confirmation, not from indicators, but from liquidity being taken. Once liquidity is swept, the market becomes free to move. Before that, it's usually just bait. If you're still placing your stops exactly where everyone else does, pause this video later and rethink your last 5 losing trades. You'll start seeing the same pattern over and over. Now let's talk about how to protect yourself. First, stop using tight, obvious stops. If your stop is sitting right above a high or below a low, you're basically advertising your position. Second, wait for price to show intent after liquidity is taken, not before. That's where patience comes in. And most traders fail right there. They want to be in the move. Smart money wants to be in the reaction. And third, accept that missing trades is part of winning. This is huge. Retail traders feel pain when they miss a move. Professionals feel pain when they enter bad locations. Those are not the same thing. Once you stop trying to catch every move, your psychology changes. You stop revenge trading. You stop forcing setups. You stop overtrading. And that alone can completely change your results. Here's the mindset shift that matters most. The market is not a place where you prove you're right. It's a place where you wait to be paid for being patient. Liquidity is the roadmap, not indicators, not opinions, not predictions. And once you stop being liquidity for others, you finally give yourself a chance to survive. If this video changed the way you look at charts, do 2 things right now. Subscribe to the channel and comment liquidity mindset below. Because the traders who understand this concept early are the ones who stop repeating the same mistakes year after year.